and a warm welcome to this week's video update by Zenergy. My name's Scott and I'll be taking you through the slides. This is our 5th edition now, and as always I'll be recapping what's been driving prices and the price movements over the last week, and we'll just look at some key topics to take note of. So first we'll start with the gas market. So gas has contracted and gone down week to week. So if you watched last week's update, you would have seen the gas market has fallen. It has fallen again. We are seeing this exact same pattern in that your typical 12-month price or 1-year price is showing a greater reduction compared to the year 2 and year 3 prices. So we're seeing a strong resistance in the more longer term contracts and further dated months, but in the near term prices are easing off, and that backwardation in the market where your near-term prices are higher than your longer-term prices is contracting, and that's happened over a couple of weeks now, and I would not be surprised if we saw this invert at some point, either this month or next. So just to recap, so a typical 12-month price is down around 7%, whereas a 3-year or 36-month price is flat, showing no change week to week. Moving on to power. So power paints a similar story. The reduction we're seeing in the power market is less. So a 12-month price is down around 4.3% compared to the 7% we saw in the gas market. And the other key difference, I guess, is the resistance is perhaps stronger in the longer term pricing as well on the power market. And we're actually seeing a typical 36-month price actually gain value week to week. Again, highlighted in red just to illustrate that in text. But yeah, overall, as an average, power market has reduced as well. But yeah, very tellingly differently between your year 1 and your year 3 kind of price ranges. So what's been driving prices and moving them last week? So there are 4 kind of key topics I've picked out to discuss. So the first one, and perhaps the biggest one, was that Russian gas flows did pick up just before Easter. So Wednesday into Thursday, we saw a notable increase. In the Velkling-Caspian point, we saw a 30% increase in Russian gas flows. This did help to slump prices down just before the weekend. As well as that, we've been seeing some warm weather. So there was a lot of warm weather last week, and the weather forecasts for this week are similar, if not higher. So we are seeing that take away any heating requirements or easing heating requirements, which reduces gas demand. And outlook looks good for this week, and it's just clear to see that we're kind of entering spring now, and winter's well behind us. There was a huge amount of LNG deliveries so far this month. So we've seen 19 LNGs delivered so far this month, with another 14 expected before the end of the month. That would bring us to just shy of January's record, which was 35. So if that is delivered all on track, it would be a very strong month, the second strongest month on record, which is helping to ease prices. And that might be why you're seeing such a reduction in short-term prices, given LNG is a short-term kind of delivery. And linking on to that is the Chinese lockdown influencing commodities, and one of those is LNG. So China are taking a complete lockdown approach in many of their cities to try and stop COVID-19 spreading. Obviously, as a result, this is causing the nation as a whole to reduce its energy demand as people are locked indoors, and it's reducing the need for their oil and LNG consumption. And this is just making those markets a little bit less competitive. And certainly Europe is not having to compete with Asia in the way it should if the lockdowns were not occurring. So these are 4 key factors that happened last week. Pretty much all of them are bearish and weighing down prices, mainly in the short term. So if we just look over oil and coal a bit more specifically, so if we start with oil, or Brent oil, we've seen it rebound over the last week, and particularly over the weekend and Monday. So it's gained about $5 to $10 week to week. I believe. And one of the main reasons why was the incident in Libya, which their main oil out production plant can't facilitate the orders anymore, given the civil unrest and process over there in the country. So that has impacted the global supply chain of oil, and the market has taken that risk on board and priced accordingly. So we're seeing oil definitely on a more bullish trend again. It has bounced around the last 2 weeks, but is still firmly well above that $100 range. Coal, again, another strong week for coal. It's had 2 successive weeks back to back, and it's approaching that recent all-time high again. It hit. So we're seeing, if you just look at the graph, about mid-March, we saw that notable dip in coal prices. It has more or less since recovered all of those losses, just a tad under its all-time high when the war broke out. So I'd expect that trend to continue if nothing changes really globally with the geopolitical drivers. We just take a look at carbon now. So the carbon market is much less volatile compared to the oil and coal markets right now. Very much still consolidating, particularly the EUA market. So that has really consolidated over 3 weeks now, around the 78 to 80 euro a ton range. Again, like the previous weeks, the UK carbon market is still trading substantial premium compared to the European one. But again, is consolidating I'd say weaker compared to the European one. There's still a consolidation pattern that you can see. As always, further information is publicized on our website, and we do have a Market Watch Live team, which is available between 10 and 12 Monday to Friday to talk to as well if you have any questions.